Welcome to the Investing Insights podcast from Morningstar.com. In this week's podcast, Mike Hodel highlights two new dividend opportunities for 2020. Equity analyst Erik Compton provides insights on how the current economic cycle might affect banks. Manager research analyst Linda Abu-Mushrafova shows how investors can diversify with mid-cap funds. Karen Anderson explains how ESG issues impact big pharma and biotech companies. And Christine Benz with key takeaways from annual projections issued by several investment firms. Let's get started. First, Mike Hodel highlights two new dividend opportunities for 2020.
A year ago, we highlighted four dividend picks for 2019: UPS, Wells Fargo, KLA Corp, and ExxonMobil. This time, we'll take a look back at how those four firms have fared and offer two additional ideas for the coming year. The performance of the four 2019 recommendations has been mixed. At the top, KLA Corp has done great, returning about 75% over the past year. Demand for semiconductor equipment has held up better in 2019, and the outlook for 2020 is pretty strong as well. While this is great news for those who have invested in the stock, income-focused investors have better opportunities in our view. The yield on KLA shares is now below 2%, and the stock trades at a premium to our fair value estimate. UPS has performed reasonably well, increasing about 16% over the past year. While this return trails the broader market a bit, investors enjoyed a 5.5% dividend increase during the year, collecting a yield of about 3.9% during 2019. UPS still offers a dividend yield in excess of 3%, and the shares look roughly fairly valued to us at this time. That's the good news. On the negative side, both Exxon and Wells Fargo have delivered single-digit percentage declines over the past year. Exxon's challenges are primarily industry-related, as the price of oil has generally drifted lower over the past 18 months. Unlike its major oil peers, Exxon is investing fairly aggressively to increase production in the coming years, a move we expect will pay off over time. Even with the pressure facing the business, Exxon has increased its dividend 6% over the past year. The shares now yield more than 5% and trade at a 20% discount to our fair value estimate. As for Wells Fargo, the firm's challenges have been mostly self-inflicted, related to the fallout from past scandals. The firm reported disappointing fourth quarter earnings on legal challenges and elevated expenses. We've long held that the turnaround at Wells will take years, not months, but that investors will be well rewarded for their patience, and we still believe this is true. And one of the positives from the firm's current predicament is that it has lots of excess capital. The firm received regulatory approval to increase its dividend more than 13% in 2019, and the stock now yields more than 4%. Wells was also approved to continue heavy share repurchases, buying back more than 9% of its shares over the past year at prices we believe are attractive. Okay, for new dividend ideas, we'd highlight chemical company DuPont and apparel manufacturer Hanes Brands. Narrow moat DuPont trades at about a 35% discount to our fair value estimate and provides a roughly 3.5% dividend yield. The firm is the product of the Dow and DuPont merger and subsequent divestitures, creating a strong specialty chemical company with products like Kevlar and home wrap Tyvek that serve a wide variety of end markets. DuPont recently agreed to merge its nutrition and biosciences business with International Flavors and Fragrances, which will provide about $7.3 billion in proceeds to the firm. We expect DuPont will use this cash to pay down debt, further strengthening its balance sheet, and repurchasing shares at attractive prices. Morningstar has long liked Hanes Brands shares, but the stock has languished for several years. At this point, it trades at a 50% discount to our fair value estimate and offers a 4.2% yield. The firm is the market leader in innerwear sales in the US and several other countries, and it owns the resurgent Champion brand in the athletic apparel market. Hanes has struggled to grow absent acquisitions in recent years, as several traditional retailers have faltered. But efforts to cut costs and improve efficiencies have lifted margins and cash flow. We expect free cash flow of about $600 million in 2019, up about 7% from the prior year. Hanes has been using cash in excess of dividends to repay debt taken on to fund past acquisitions, cutting its debt load about 12% over the past year. We expect debt reduction will remain a priority for the firm over the next couple of years.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit Morningstar.com/Alexa.
Now, equity analyst Erik Compton provides insights on how banks might be affected at this point in the economic cycle.
The current economic expansion has gone on for more than 10 years, and it seems we are closer to the end of the cycle than the beginning. As such, having a view on future credit costs for the banks is invaluable. we find that banks' credit costs are difficult to analyze for investors, and for good reason. It is quite difficult to gather and make sense of the disparate, diverse, disjointed, and even discordant information available on the subject. To help investors make sense of credit costs for the banks, we recently conducted a deep dive on the subject. We find that predicting the timing of a cycle is inherently difficult, if not impossible. But even if perfect timing isn't a given, there is still room for worthwhile analysis. In our deep dive, we analyzed each section of the debt markets, analyzing where we see elevated risks and where we think the risks are manageable. Our big takeaway is that risks currently appear manageable for the banks, with the riskier asset classes generally being concentrated outside of the banking system. As an example, we see some of the most irrational behavior within student lending, but over 90% of this market is controlled and underwritten by the government, not the banks. We also dive into leveraged loans and CLOs, two areas which have captured investor and regulatory scrutiny over the last several years. Again, we find that the risks here appear manageable for the banks, and we see nothing like a 2007 type buildup occurring today. As such, our overall thesis is that the next downturn will be mild compared to 2007, and it will not be as concentrated within the large banks. After combing through the debt markets, we applied our methodology to the banks under coverage and have updated our through-the-cycle net charge-off projections for each bank. Some banks saw minimal changes, while others saw changes which affected our fair value estimates. We also applied our moat methodology and find that Cullen/Frost and M&T Bank have demonstrated moat-worthy credit advantages over multiple cycles. We also find that formerly BB&T, now Truist, has done well, and we will be closely watching Truist to see if the advantaged BB&T underwriting culture triumphs in this combined company. Overall, we see credit costs continuing to normalize as the cycle develops, but don't see a 2007 type downturn for the banks on the horizon. Please see our latest writing and updates for more details.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, manager research analyst Linda Abu-Mushrafova shows how investors can diversify with mid-cap funds.
Mid-cap equity exposure is a great way to diversify a portfolio. Managers looking for stocks in the mid-cap space can identify companies that have grown large enough to exit the small-cap arena, suggesting that they are more established and often less risky than their small-cap counterparts, but still have runway for growth and can evolve into a large-cap name. Currently, the Russell Mid-Cap Index benchmark has an average market cap of roughly $14 billion, versus the Russell 2000 indexes, a small-cap benchmark, $2 billion average, and the Russell 1000 indexes, a large-cap bogey's $95 billion. For mid-cap blend exposure, we like gold-rated FMI common stock. A stable 10-person management team adopts a collaborative, high-conviction approach that has rewarded investors through strong stock picking since CIO and longest-tenured manager Patrick English joined the squad in October 1997. In the mid-cap value category, gold-rated Diamond Hill Mid-Cap stands out. It boasts a deep, stable bench helmed by veteran manager Chris Welch. He collaborates with Diamond Hill's analysts to apply its disciplined approach to value investing. The track record here is still short, but he's proven the merits of the team's bottom-up stock-picking prowess and similar charge Diamond Hill Small Mid-Cap, which is close to new investors since its December 2005 inception. We expect investors to reap the benefits of the team's responsible approach in this iteration over the long haul as well. Silver-rated MFS Mid-Cap Growth is a fine choice for mid-cap growth exposure. It benefits from an experienced and well-resourced management team that has consistently applied its investment process focused on uncovering mid-cap firms whose earnings and cash flow growth prospects are underappreciated by the market. Finally, investors could opt for a passive option, such as gold-rated Vanguard Mid-Cap Index, to gain exposure to the mid-cap arena. Whether active or passive exposures, investors should consider adding a dedicated mid-cap equity fund, as it can serve a valuable role in a diversified portfolio.
Now, Karen Anderson explains how ESG issues affect big pharma and biotech companies.
The investor community is increasingly interested in incorporating environmental, social, and governance risks into their decision-making. Morningstar is working with ESG research firm Sustainalytics, which is 44% owned by Morningstar, to delve deeper into the issue. When our healthcare team at Morningstar incorporated ESG factors into our evaluation analysis for big pharma and biotech firms, we focused on ESG issues in the social realm, including pricing and litigation risk, which we think are the two most material issues. Pricing remains a major headline risk for branded drug firms, particularly those with larger exposure to the U.S. market. If major U.S. drug pricing reform is signed into law, we assume an average 11% hit to U.S. branded drug sales starting in 2023, when changes could be implemented. We're most concerned about companies that sell therapeutics that are not cost-effective or have major discrepancies in price between the U.S. and other developed markets, because we think they are most vulnerable to potential drug pricing reform. For example, Biogen and AbbVie have taken large U.S. price increases in immunology and multiple sclerosis. While undervalued, we think these two firms have the highest pricing risk in our coverage. Looking at the results of our ESG analysis, a few firms do stand out as attractive on both valuation and ESG risk. Roche's oncology portfolio, global pricing strategies, and diversification from diagnostics all lower pricing risk. BioMarin's global pricing strategy and ultra-orphan disease focus should make it more immune to pricing reforms. Gilead's HIV portfolio has a history of relatively steady U.S. pricing, and Sanofi is diversified enough with rare disease exposure that pricing risk should be more limited.
Expand your investing horizons and look to the long term with Morningstar's new podcast, The Long View. Join hosts Christine Benz and Jeff Patek as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. And lastly, Christine Benz with key takeaways from annual projections issued by several investment firms.
Hi, I'm Susan Chubinski from Morningstar. Every year, Christine Benz pulls together a compendium of forecasts from the major investment firms for long-term stock and bond returns. She's just published an article on this topic, and she's here today to discuss the key takeaways from it. Christine, thank you for joining us today.
Susan, it's great to be here.
Let's first talk about why these firms put out these forecasts at all, because isn't it really difficult to predict what the market's going to do?
Well, it is, especially over the short term, but the fact is many of these firms are doing this type of research when managing their own products and portfolios that they run on behalf of clients. And it's also instructive for us individual investors or advisors managing client portfolios to have some expectation of what various asset classes will return, because that in turn will influence some of the decisions that we make, like what is our savings rate like? When do we retire? If we have some idea of what the market will return, that helps us figure out how much of the heavy lifting we'll have to do ourselves.
And then how do these firms go about even coming up with these forecasts?
Well, for fixed income investments, it's usually starting yield is used as the key determinant. And the reason is that as a bond investor, the yield you earn is the main component of your return. And yields have been extraordinarily predictive of what fixed income assets have earned over time. So that's the starting point that most firms use when looking at fixed income. In terms of equities, most of these firms use some combination of their expectation of dividend yields, of earnings growth, as well as PE expansion or contraction, multiple expansion or contraction. Usually those inputs figure into most of these forecasts.
So let's dig into some of the specifics, starting maybe with U.S. equities. You know, the past decade's been terrific. What are the forecasts for the 20s looking like?
Well, the general overview headline is to temper your expectations for U.S. equities. As you said, Susan, the past decade was tremendous, where you've got like 13% returns over the past decade annualized. Most firms think we're unlikely to repeat that, and the forecast went from downright gloom gloomy, where I would say Grantham, Mayo, Van Otterloo sits there as sort of the bearish forecasters, especially for U.S. equities, where they're forecasting a 4.4% real, so inflation-adjusted loss for U.S. equity investors. They do their forecasts over a 7-year horizon. Most other firms weren't quite as pessimistic as that. In fact, I think there was some convergence in kind of the mid-single-digit range for U.S. equities over the next decade. Vanguard, interestingly, takes a look at different market subcomponents. So within the U.S. equity market, they are forecasting relatively worse returns for growth stocks, pretty intuitive given how great growth stocks have been, better returns for value, better returns for small caps.
Interesting. Now, how did these expectations that you've, collected this year compare to this time last year?
Well, I was curious about that. And one interesting takeaway is that there was no clear consensus in terms of whether firms expected to see better or worse returns than they did a year ago. So a few firms, JP Morgan and Vanguard among them, actually said that they had slightly higher forecasts, by no means really optimistic forecasts for U.S. equities, but slightly higher forecasts because they thought valuations actually looked a little more attractive. For other firms, especially the very valuation-conscious firms like Research Affiliates and GMO, they actually had pushed their forecast downward a little bit between 2019 and 2020.
Let's pivot to foreign stocks. How do things look better there than the U.S. stock market, according to these firms?
Well, here's one spot where there does seem to be some consensus among these firms, where there's overall a widespread expectation that foreign stocks will outperform U.S. Not by a lot, but certainly every firm was expecting non-U.S. names to perform better. There's a little bit of a divergence in terms of developed markets equities versus emerging markets equities. Again, the valuation conscious shops really think there's a lot of value in the emerging markets equities space. Other firms think that developed markets equities are just as attractive. And I would call out Morningstar Investment Management as a firm that has believed that developed markets equities, the prospects for them are every bit as attractive as emerging markets equities.
And then what about fixed income? What about bonds?
Well, here there were few optimists, where, again, if we're using starting yields as the baseline, yields have come down, and that in turn causes these firms to temper their forecast for bonds. So most firms tended to kind of converge in the 2% to 3% range over the next decade. Most acknowledge that, of course, you can pick up a higher return by venturing into lower quality bonds, but of course you have the trade-off of higher volatility with the low credit quality products. One interesting theme that I picked up on, though, is that several of these firms took pains to caution people not to abandon bonds despite their meager return prospects. And the key reason is that bonds are shock absorbers for your equity portfolios. I think a few of the firms hinted that there could be some sort of equity market shock sooner rather than later, and you'll be happy that you hung on to fixed income assets, meager yields and return prospects and all.
So what should investors do with these forecasts?
Well, I think if you're using any sort of return calculator, you're typically given the option to adjust your return assumption. My thought is that for equity returns, you probably do want to give your return assumption a little bit of a nudge down, maybe be a little closer to, say, the 6 to 7% range, even for like a 25-year time horizon, simply because the next 10 years might not be that good. And I think there are also implications here, especially for people who are just embarking on retirement, where that sequence of return risk that we've talked about so often, where you have a market shock early on in your retirement, can be so painful to the sustainability of your plan. Make sure that you have laid the groundwork so that you are not having to withdraw from depressed equity assets in case you are an unlucky person who retires into a tough equity markets. So those would be a couple of the key things that I'd be thinking about right now. The other thing to think about, maybe on a more positive note, is if foreign stocks are set to outperform U.S. and you haven't revisited that asset allocation recently, take a look at that. Maybe nudge a little bit more into the foreign stock column, or at least readjust, rebalance, because U.S. stocks have outperformed foreign for so long.
Christine, thank you so much for the perspective and helping us set some realistic expectations.
Thank you, Susan.
I'm Susan Jabinski from Morningstar. Thank you for tuning in.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you've enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.